In late August, US FOMC Chair Jerome Powell announced a significant shift in the committee's policy mandate. Targeting 2% inflation on average over time in pursuit of full employment means US monetary policy will remain ultra-accommodative for an extended period. The revised forecasts from the September FOMC meeting highlight just how extended this period will be. The annual forecasts offered by members of the FOMC now stretch to 2023. After an upwardly revised 3.7% contraction in 2020, the median expectation of the committee is now for GDP to rebound 4% in 2021 and sustain a well above trend pace in 2022 and 2023 at 3% and 2.5% respectively. Even if the outlook runs to this optimistic expectation, the level of GDP at the end of 2023 will still be around 2 percentage points lower than if the FOMC's estimate of potential GDP growth of 1.9% had been seen over the 4 years to December 2023. In line with this lasting consequence of COVID-19 for GDP, the FOMC also see a permanent cost for the labour market from this pandemic. The median expectation for the unemployment rate at end 2023 is 4%. Versus history, this would be quite a good result. But when compared to the 3.6% unemployment rate experienced in the year prior to COVID-19, it signals that 3.5 years of recovery from 2020's recession is likely not enough to remove the shortfall of employment from its maximum level. This notion is backed up by the committee's view on inflation. Headline and core inflation are only seen getting to 2% in 2023. If these forecasts transpire, then the inflation deficiency that the FOMC is seeking to rectify by pursuing full employment will only have gotten larger over the forecast period. The scale and longevity of this undershoot of the inflation target must be emphasised here. It has been with us ever since the GFC, with core inflation having averaged 1.6% over the 10 years to July 2020. So, what are the monetary policy implications of these forecasts? Unsurprisingly, the median expectation of the committee is for the federal funds rate to remain at 0.125% to at least the end of 2023. Even though their longer run expectation for the policy rate is still 2.5%, a move up to that level would only be justified by a lengthy period of robust growth for the economy beyond 2023. This does not necessarily mean that asset purchases will continue to 2023 or beyond. The statement only makes a commitment to sustain purchases of US Treasury and mortgage-backed securities at their current monthly pace of around $80 billion and $40 billion respectively over coming months. That being said, the continued inclusion of the phrase "at least" with reference to the current pace makes clear the committee's concern over downside risks and implies that a partial, then full tapering of asset purchases is also a long way off. These highly supportive conditions for risk assets, such as global equities and the Australian dollar, create cause for concern over financial stability. While clearly mindful of this issue, faced with such a dramatic deficiency in activity and employment from potential levels, and given global economic uncertainties, the FOMC is likely to continue trusting in the market's ability to value assets and the Federal Reserve's own prudential regulation of the banks, and pursue a path for the economy that is most likely to achieve full employment and 2% inflation over time. This requires extraordinarily accommodative monetary policy as far as the eye can see. We'll see you next week.